This is Its Financial History 2, where money's past reveals tomorrow's truth. What if I told you that the single biggest force driving the U.S. stock market used to be a federal crime? Not a loophole, not a gray area, a crime punishable by prosecution. And today, it's the foundation of modern capitalism. Welcome to the Its Financial History 2. Once upon a time, what Wall Street now calls shareholder value was simply manipulation. When a company used its own money to inflate its stock price, that wasn't strategy, it was fraud. Executives could be arrested, corporations fined, reputations erased. Today, the very same tactic, stock buybacks, has become the most powerful engine in corporate America. They lift markets, inflate CEO bonuses, and quietly transfer trillions to shareholders, all without creating a single new product or a single new job. So, how did something once treated as corruption become the backbone of capitalism? Welcome to the Financial Historian, where money, power, and history collide. And nothing is ever as simple as it looks. The origin, a crash that changed everything. The story of buybacks begins with a collapse. In the roaring 1920s, the stock market was a casino disguised as an economy. Executives manipulated prices, bankers engineered insider deals, and fortunes rose and vanished overnight. When the crash hit in 1929, the truth came out. Corporations had been secretly buying their own shares to prop up prices, creating an illusion of stability. When panic spread, those same companies dumped shares to survive, accelerating the collapse. By 1933, faith in capitalism was broken. Banks failed, factories shuttered. Unemployment hit 25%. The public no longer trusted Wall Street or the idea of an honest market, so the government stepped in. The rules that banned buybacks, FDR's administration rewrote the rules of capitalism. The Securities Exchange Act of 1934 created the SEC and made one thing clear: companies manipulating their own stock prices would not be tolerated. Stock buybacks weren't banned by name, they were banned by definition. For the next 50 years, executives avoided them like landmines. Corporations reinvested profits in workers, factories, and research. CEOs were builders, not financial engineers. America grew, not through tricks, but through production. The idea that changed everything. Then came the 1970s, not a political movement, an intellectual one. Milton Friedman introduced a radical idea. The only responsibility of business is to increase shareholder value. To corporate America, this was liberation. No more loyalty to workers, no more obligation to reinvest. Just one mission: increase the stock price. By the 1980s, that philosophy met its perfect ally, Ronald Reagan. Deregulation, free markets, Wall Street unleashed. And corporate America wanted a shortcut, a way to lift stock prices fast. They didn't want to build value. They wanted to buy the appearance of value. 1982, the rule that changed capitalism in 1982. With almost no public attention, the SEC introduced Rule 10b-18, a tiny one-page regulation that acted like a nuclear bomb. It created a safe harbor, allowing companies to repurchase their own shares without being accused of manipulation. Overnight, what had once been a crime became perfectly legal, as long as companies followed a few loose guidelines. No debate. No hearings, no public awareness. Just a single rule that reshaped the next 40 years. The explosion of buybacks. Before 1982, buybacks were rare. After 1982, they exploded. 1990s. Over $100 billion a year. 2000s. Buybacks became standard corporate behavior. 2010s. They crossed $1 trillion a year. Why? Because buybacks are the simplest financial magic trick in existence. Fewer shares in circulation. Same profits, higher earnings per share, higher stock price, bigger bonuses for executives, no new factories. No new jobs, no innovation. Just math. Buybacks were capitalism's version of plastic surgery, making companies look younger, stronger, more profitable than they really were, and Wall Street was addicted. 2008. The lesson corporations didn't learn after the financial crisis. When taxpayers bailed out the banks, something unbelievable happened. Those same institutions spent the next decade using profits and borrowed money to buy back shares. Between 2009 and 2019, the top 500 U.S. companies spent over $6 trillion on buybacks. More than they spent on all new capital investments combined. Buybacks didn't build resilience, they built illusions. And when the illusion cracked, the public paid the price. The Great Shift, from capitalism to choreography by the 2010s. Entire industries, tech, airlines, retailers, had transformed into financial machines. Their main product was no longer innovation, but shareholder returns. Apple, Microsoft, ExxonMobil, just 3 companies accounted for over 20% of all buybacks. The result? Wages stagnated, productivity stalled, corporate debt doubled. The top 1% captured almost all the wealth. Buybacks turned the economy inward, companies feeding on themselves. And governments helped it happen. Why? Because rising stock prices became a substitute for real economic health. If the markets looked strong, leaders looked strong. Appearance replaced reality. The dangerous illusion. History is repeating itself. The 1920s were built on cheap money, inflated stocks, and blind faith. So is today. When a system rewards appearances over productivity, when manipulation becomes policy, when value is replaced by valuation, collapse becomes a question not of if but when. Buybacks were marketed as efficiency. What they created was fragility. They shifted capitalism from creation to choreography, a dance designed to make decline look like progress. Conclusion plus call to action. Stock buybacks weren't just legalized, they became the operating system of modern capitalism. A system where profit replaces purpose, where numbers replace innovation, and where illusions replace value. If this gave you a new perspective on how financial power really works, hit the like button and subscribe to the channel. History has the answers, and I'll show you where to look next.